In part one, we walked through four different retirement planning strategies for the same couple, Mark and Carol, with approximately $2.75 million in investable assets and a fully paid off home valued at approximately $900,000. We explored how different Roth IRA conversion decisions and even choosing not to do Roth IRA conversions at all could lead to a very different retirement outcomes. Together, we visually compared retirement income, retirement spending, taxes, legacy outcomes, and what happens when one spouse passes away. What made this case study so interesting was that the couple never changed. Their assets never changed. Their retirement date never changed. Only the planning decisions changed, yet the outcomes looked dramatically different.
And after doing part one here, we decided to do this part two as we received many questions from many different people that wanted us to go deeper and expand upon the four plans in there. They wanted to see actually what was happening beneath the surface, the estimated lifetime taxes amongst the four plans, what happens to Medicare IRMAA, how do required minimum distributions or RMDs impact the overall picture. Where should retirement money actually come from? Should the greatest net income come from Social Security benefits, traditional IRA or 401k, the Roth IRA, the taxable brokerage account, long-term capital gains, a different combination, or all of the above?
Yeah, and many people also ask an important question that often gets overlooked. What about the home? For many families, the home is one of the largest assets that they own, yet it's rarely included in the retirement planning conversations. How can it be used during retirement? What happens if it's sold? What happens if it passes to heirs? How does it fit into the larger picture of retirement taxes, estate planning, and legacy?
Yeah, and those are the exact kinds of questions we're going to look at here today, visually showing you several visuals throughout here, going over these visuals so that you can see it here as well on these different plans for this couple. And you can see a deep analysis on this from, again, those lifetime taxes to the IRMAA, to the four plans, to the inheritance, to the estate, to the home value. We're going to show you these same visuals that we share with our own clients and the own people we guide here as well, what your own plans could look like and what the potential outcomes could be. That way you know what's going on with your money and the sources, the incomes, the taxes, and what even happens when you pass away and your spouse is left alive with that surviving spouse example too. So that way you could see what even happens with that primary residence, as Ashley was saying.
Yeah, and because retirement planning is not simply about how much money you have, it's about understanding how all the pieces really fit together. Your taxes, your investments, your income sources, your home, your spouse, your family, and the future that you're trying to create.
Yep. So again, my name is David Lumberg. I'm a co-founder of Awaken Financial Designs, a fiduciary RIA, financial planning, and tax strategy. We are headquartered in North Carolina and Arizona, but we help people out virtually nationwide. We're licensed to do so. I have 2 master's degrees, certificate in financial planning, Marine veteran, and I've been doing this since 2015.
Yes, and I'm Ashley Lundberg. I'm co-founder of Awaken Financial Designs. I'm a wellness coach and financial educator. I have my master's degree in business leadership, and I'm also breathwork, pranayama, meditation, yoga certified.
Now, again, this is educational only. This is not financial, tax, or legal advice. Always consult a professional about your own situation, your own impacts, your own goals and needs. For the purpose of this video, we have changed the names for privacy. We have also changed some of the variables on here as well for privacy. So keep in mind, these are estimations and hypotheticals on these numbers. They're not exact, but we're giving you a very close visual of what these plans could look like for this couple so you can see the data. So that way you too can ask yourself, do I have a plan like this? Can I see this in my own plan? Now, before we begin to look at taxes, retirement income, the estate planning, all the visuals we'll be showing you here as well, the legacy and estate outcomes, and the different visual impacts amongst this couple we're sharing with you today, we wanted to slow down for a quick moment here and just be fully in the present and just to get the mind ready for what is about to come, because these decisions today that we'll be sharing, they're not just simple financial decisions, right? They affect our time, could be years of life. They affect our family and our loved ones. They affect our future. future. They affect our money and so much more.
Yeah, and as both
Yeah.
Yoga Alliance certified yoga teachers, meditation practitioners, and students of pranayama breathwork, we'd like to share a brief breathing technique with you called fire breath. The style of forced exhalation may help reduce the stress, boost brain function, and improve respiratory health. It's also said that it strengthens the abdominal muscles and improves digestion. Participation is totally optional, but please be mindful of your own medical conditions and listen to your body. If at any point you feel uncomfortable, simply return back to your normal breathing pattern. With that said, let's take a moment together to become present, focused, and ready to explore the possibilities ahead. We will be quickly breathing through the nose and out the nose rapidly and controlled for ideally 20 to 30 seconds at least, but today we'll just do 20 seconds. I will count and guide while David demonstrates. So you're going to go ahead and you're going to sit up nice and tall, your hands on your knees or your thighs, and for support as needed. And ready, begin. 15. Now, when I say 0, deep inhale, you're going to hold for 5 seconds. 4, 3, 2, 1, 0. And sigh it out. Beautiful.
So again, as Ashley was saying, we are both yoga teacher certified with the Yoga Alliance, and pranayama breathwork is such an integral part of the mind, body, soul connection for wellness too, which is a big part of what we do. But that was just a brief example of the pranayama rapid fire or fire breath. Ideally you want to do it at least 30 seconds. You could go a few minutes depending on your comfort level on there, and you want to alternate those sighs in there to regulate the body and the nervous system. Ashley, anything else before we begin?
Nope, let's go ahead.
All right. So the first visual coming up here on the screen, we're going to recap here very briefly from part 1, the prior video on here, what this was. That way you have that same awareness before we go into the new visuals on here we're going to share as well. So just a brief recap on here. Our couple, Mark and Carol. Now this couple lives in Arizona. So Arizona state taxes do apply. Be aware of your own state. And they are 66, 63, retired at age 62. They got about $2.75 million in investable assets. That breakdown's roughly the IRA is about 2.2 million. Yeah. The Roth IRA about 300,000. That brokerage account with cost basis and long-term capital gains about $250,000. The additional bank money of $150,000. They're already both taking Social Security benefits. Mark has his at about $3,100. Carol has hers at about $1,700. In addition to all this, which we're going to do a very deep dive later on, they have their primary home residence, $900,000 that is paid off that we're discussing much deeper later on in this video. And in that first video, went in depth on the 4 kind of plans. In essence, we had plan 1, do no Roth IRA conversion. They could spend roughly about $13,495 net of tax each month until projected age of death. We showed plan 2 in depth. If they did a potential Roth IRA conversion up to the 22% tax bracket, what that would look like, they could spend about $10,000 net of taxes every month. We showed plan 3, they got very aggressive. They wanted to do a Roth IRA conversion up to 32% tax bracket, which brought down their net monthly spending for a time period to only $2,400 because of the taxes they had to convert. Then we showed plan 4, a spouse passes away early. One spouse died at age 77, never did any Roth IRAs. They could spend roughly $13,000 net of tax a month. Now, again, this is a brief recap. Plan 1 did cover this, but we want to give you a quick reminder of what that was. Ashley, any thoughts here?
Yeah, so this is just one of many visuals that we do show to our clients in the planning process, but something that is just really great to see is that net income, what that looks like after taxes. And with the plans, you can truly see the difference, how plan 1, you net more, and then with the Roth conversion, how that goes down.
So again, this is one visual mini we show in the plans, but I wanted a quick reminder from the first video on here. Now, we're going to go ahead and go to the next image from part 1. Again, quick reminder on here, just on the estate, inheritance, and the legacy side. As a brief reminder from past videos and articles we have on here, when someone does receive an inherited IRA, and when they get that money, they typically have 10 years to take that money out. When they take out that money, it is taxed as income at their own tax level. We do have the inherited Roth IRA. When someone inherits that, they typically have 10 years to take that money out. That money is tax-free if it is qualified withdrawals to that person. Then we have our taxable brokerage account. Gets that step up in basis. So when that person passes away, they get an entire tax-free account, and there is no time limit on there. And we broke down these brief plans overall, as you can see here.
Yes.
Plan 1, the no Roth on there. We had roughly about 59% inherited. 23% from the taxable, 18% inherited Roth IRA. Plan 2 we went over has 100% in the inherited Roth IRAs left over. Plan 3, that very aggressive nature, 100% inherited Roth IRA. Plan 4, spouse dies early, no Roth. We had about 62% inherited IRA, 21% taxable, 17% inherited Roth IRA. And again, we're going kind of quick on this one's here because the last video went in depth. This video today is going to have newer information with newer visuals. Ashley, anything quick on this one?
So this is one of the many great visuals that we do like to see and present to our clients because it is something that you don't really talk about, but needs to be included in a plan, is about what happens when a spouse passes away and what happens to that legacy. So this is a really important visual.
I think it's another critical piece of our overall planning process we do with people here, but let's get into the newer information on here today, right? What about the lifetime estimated taxes, right?
Right.
The lifetime estimated taxes. And this screen coming up here, keep in mind, these are estimations on here. There's a number of variables in the tax software we have, the financial software we have, plus the human elements we have to add on here as well. But it's, again, federal tax. This state currently is of Arizona, so you get to input your own tax on here as well. And be aware of your own city taxes too. But really in Plan 1, this is the living tax impact. Just keep in mind, there are tax impacts when someone passes away, or tax impacts. This is just for living. And it's also not showing the net income you get to spend. So keep that in mind.
Right.
So this is one piece to show you that if they did Plan 1, no Roth IRA conversions, they would have spent roughly about $738,000 in taxes until the projected age of death. Plan 2, as a reminder, is that 22% Roth conversion we looked at here.
Right.
They would spend about $720,000 in taxes projected age of death. Plan 3, they would spend about $715,000 roughly, total taxes projected age of death. Now, Plan 4, that is where one spouse passed away at age 77. We did know Roth.
Right.
They would spend about $808,000 projected taxes while they are alive. Keep in mind, this accounts for that IRA, that Roth IRA, the Roth conversions, that taxable account, long-term capital gains, bank money on there as well. And with a system that we utilize to get the lowest tax possible to get you the greatest output possible on the net side.
Yeah.
We are also asked, what about Medicare and IRMAA? Because of course with IRMAA, as you know out there, right, there are additional monthly costs you have to pay depending on your income limits. So we looked at IRMAA on plans. So that Plan 1, about $31,000. Plan 2, we had about $48,000. And that's much higher because we converted money to the Roth, which is taxable.
Right.
Plan 3, we had even a higher IRMAA, about $73,000, because we converted a lot of money to that Roth IRA, which increased the taxable income. Plan 4, we had about $56,000 on the IRMAA level on there. And don't keep in mind, 77 that passed away, there's that widow tax that happens to that surviving spouse, and their taxes change as well. Then we had the last big question was, what about the net investment income tax? Now, that one could be different as well. But again, Plan 1, roughly about $6,800. Plan 2, roughly $5,700. Plan 3, $6,100. Plan 4, about $5,400. So nothing really significant in this area. And then the last thing I want to show you here is that on the tax-free or low tax years, on the overall plan, right, as projected age of death, we have about 0 years in Plan 1 because we never did a Roth conversion.
Right.
Plan 2, we get about roughly 8 years on there because we converted some to a Roth. Plan 3, we converted almost all of it to a Roth IRA. So we had about 19 years of no tax or low tax, but we still paid taxes for that up front. Then Plan 4, never did conversion. So we have 0 years on that as well. Now keep in mind, this is just one critical component or one critical piece with the other images we showed you and with the additional images we will be showing you in this video as well. That way you can make the best choice in your plan for awareness. But I know this was a ton of information I kind of threw at you in this image. Actually, why don't you kind of break break it down here and how a client feels when they see this, how people feel when they see this, and kind of what your thoughts?
Yeah. So the thoughts are that this is, like David said, just one key component, right, of the overall plan. So there really is a trade-off. You've got to evaluate, right, the pros and cons and what's best for your specific situation, because it's showing in plan 1, the tax-free, low tax 0 years, plan 2, 8 years, but really you want to look at everything combined all together to really figure out what is going to be the best trade-off for you.
Because wouldn't you say if you saw this and you didn't understand,
Oh, yeah.
which one would you obviously choose, Ashley?
You'd obviously I would choose plan 1.
Okay, well, that's curious. Out of plan 1, what makes you choose plan 1 there as opposed to plan 3?
So I see the 730. Oh, no, excuse me. So 715. I'm sorry. So 715, 261 for like the lowest net of the total lifetime.
Okay, so you would choose plan 3,
yes,
not plan
3.
1.
I'm sorry. Yes, plan 3.
Okay. See, it can be confusing even to someone like Ashley when she's looking at information. Well, this happens, which is why we break these down for you to see. But of course, at visual, you would say, well, plan 3, of course.
Yes.
But remember, this is not showing you the net income that you would spend each month.
Right.
It's also not showing you any kind of protections or investments
Right.
or your estate planning as well. So just one critical piece. Ashley, what else do people like about just the visual nature of this particular screen?
So it is very easy to understand once you're explained. And again, you see the trade-off and what's also really good too is, mind you, the plan 4 when your spouse dies. That's important to have as a component as well.
Perfect. Now let's get into the next screen on here. It's going to be quite a bit when it comes up. Might be very confusing. Now, a lot of people will always hear about the tax order of withdrawal, secrets of return risk, volatility drag. Also, they hear about what accounts do I pull money out of to get the lowest tax possible. Right. So we're going to break this one down here. It's quite a bit on here, but again, it's another very important piece of the planning we do with people to help them get the most amount of money they can spend throughout their life with the lowest tax possible for that greater awareness and clarity. So we have that plan 1. Now on here across the board, we kind of have our legend. We have Social Security, that dark blue. Next down is the traditional IRA, which does have RMDs eventually. We have the Roth IRA, the taxable brokerage, which does include cost basis and long-term capital gains taxes, which are different. And then we have other income, right? Might be bank income, other income as well. Keep in mind, this does not include the primary residence or the real estate, which we will be going over here later on as well. So what we look at is plan 1, percentage-wise. Where do we pull this money from? Well, in essence, in plan 1, we would have about 32% come from Social Security and 68% roughly come from traditional IRAs to ideally in that plan get them the lowest tax possible with the highest net income. In plan 2, we would go ahead and say, hey, based on that plan, 36% Social Security benefits, 16% IRA, and then 48% from that Roth IRA. Right. Plan 3, they are aggressive. Remember this one, we'd have Social Security, 32%, and the remaining would come from the Roth IRA. And then plan 4, spouse died earlier, no Roth in this one, as we showed you prior. We'd have Social Security about 21%, traditional IRA about 64%, the Roth IRA 8%, taxable about 7%. But keep in mind, when a spouse passes away, you lose a Social Security check. You only keep one of the two, and it's the highest of the two. And they also go to a single tax filer status, and their standard deduction also gets cut roughly in half, roughly as well. So plan 4, there are a lot more nuances here as well to be aware of. Now, as a reminder, how these accounts are broken down also does matter. In the beginning, we gave you the total values, but each person has their own value, which matters for their age and matters when they pass away. So we had Mark himself, IRA, about 1.5 million. Carol's IRA, about 700,000. Taxable brokerage, we had about $250,000 joint. Mark's Roth IRA, 200,000. Carol's Roth IRA, 100,000. In addition, we had that bank money of $150,000. Now remember, that is the starting point of the plan. So that's when their plan started overall. What we are showing you here is say, hey, in 2039, because we could choose any year, see all years together, we are showing you in the year 2039, the ideal spot to happen on there in 2039 also accounts for one of the spouses passing away here as well. But we break all this down in such greater detail as well in our planning process, and we will be getting to the real estate in a few moments, but I'm going to step back, take a breath. I'm going to go ahead and let Ashley jump in here to kind of break it down for everyone else out there and kind of what she thinks.
Yeah. So again, this is another great visual that we show in the overall piece of the puzzle, right? In the plan. And again, outweighing the pros and the cons, because this is really a great visual because it shows where to pull from and you can actually see the percentages and how it looks. But then keep in mind, like David said, the net of what you have after tax, that matters as well. But this is really great because it does show that spouse passing away and you end up in that single tax bracket. So you would want to be aware.
I mean, otherwise, wouldn't you say most people always ask us where to pull the money from? And like
Yeah,
most
no,
people,
it's a great
right,
visual
like
to
people
show.
guess, right? I mean,
Yes.
if you had 5 or 6 tax account types and you didn't have a
Correct.
recipe or a formula,
You definitely need that.
right, you would take your best guess.
Mhm.
Now, I mean, this could cost you tens of thousands in taxes.
But
This
to
could cost
see
you a vacation. This could cost you whatever it might be, right? But that's why these recipes and these
visuals,
formulas, they are
absolutely.
best estimations to help you to give you that guidance
That
on
peace
there
of
and not
mind.
that guessing.
Yes, exactly.
Ashley, anything else in this particular one you kind of notice or how someone feels when they see these?
I mean, again, right? It's a lot of information, but it's succinct in the sense of, like David said, where you're pulling from so so you're not guessing and you have somewhat of an understanding.
Perfect. So let's go into our third new visual here tonight on the real estate or the primary residence or the home on
Mhm.
here as well, which is another big asset people have.
Mhm.
Now, what people don't know here is that most financial planning softwares, and I've used so many over so many years,
Yes.
the primary residence, right, it's always included there as a net worth, right, or as an asset. But until you actually sell the home, there's no cash flow from that house. Until you actually maybe do a reverse mortgage, there's no cash flow from that house. So the home sits on that balance sheet as an
Mhm.
asset added to the net worth, but not part of your investable assets.
Right.
So what we should be on here is Mark and Carol. They have their home paid off about $900,000 roughly. You can see there
Mhm.
in box 1. Their cost basis is about $760,000. They have a gain of roughly $140,000. However, keep in mind as your primary residence, right? If you live in that home and you follow the laws, each person can have $250,000 of capital gains excluded from
Mm.
taxes if they sold this. So if they sold
Yes.
this, there'd be no tax to them at the current rate. Now, number 2 is what happens if they both passed away? What happens if they pass away? What happens to that gain? Well, the value gets a step up in basis. Kind of similar to that taxable account. There's a step up in basis at time of death. So then it would go from the $760,000 stepped up to $900,000 of basis, and there'd be no tax to that rightful heir or qualified heir that is on there. Now, again, people then say, well, what if I need to access money in my home? What if I want to access money in this house,
Mhm.
right? Now, one way to look at this is a reverse mortgage. And again, we are flat fee financial planners. I don't make any money on reverse mortgages. I
Right.
don't make any money on home loans or anything. I'm here to educate it as well.
Sure.
But a reverse mortgage, in essence, right, there's a number of variables involved. But let's say it lets you have 20% of the home's value accessed as equity tax-free. This case, say $180,000. It's $180,000 now that they can sit in a separate bank account.
Mhm.
That money is tax-free from there. You don't have to use it if you don't want to use it on there. That's additional cash flow that you still have, and you still own the home there as well. But that's additional cash you can have to be aware of as an option. Then in the future, of course, if you ever downsize that house and you sold it in the future, that's additional cash that comes back into the plan. Or we could see what happens on that plan as well. Maybe it's long-term care
Yeah.
or living in a nursing home, but the home value does matter in addition to the plans we showed
Mhm.
here earlier as well, which is a key piece also.
Absolutely.
Ashley, what's kind of your thoughts on screens like this?
Yeah, I think that this is really great because as you mentioned earlier, it typically isn't shown in a financial plan and it is a great additional, right, retirement asset. And so to be able to include this and know that you have, that legacy that you're leaving generational, it's just important to know that you have that as well and gives them peace of mind and clarity too.
Yeah. Now, I mean, that was the home value. So, I mean, today, thus far, we have some more to go over here as well. We showed you from part 1, quick recap. We showed you
Mhm.
today the lifetime taxes on here. We also showed you the home values on here. We showed you the breakdown of the tax or withdrawal. Ashley, what's kind of our next thing here now?
Yeah. So as you've watched, right, these two videos, imagine applying the same type of analysis to your own life, your retirement, your accounts, your taxes, your spouse, your home, your children, and grandchildren. Because while Mark and Carol were hypothetical, the questions we explored are very real for millions of families. What happens if one spouse passes away? How much tax might be paid over a lifetime? Which account should retirement income come from? How does a home fit into a retirement and legacy planning? And what opportunities may exist that simply have not been identified yet?
Yeah, and that's why we've created this case study
Yeah,
here to share with you today from so many real clients we have helped that are similar to people we have talked to are similar because education, awareness, and clarity is key. And not that stress, that fear, that
right.
guessing, the
That
unknowns that
piece.
can really happen. That way you could find out, not to tell you what decision to make, not to suggest which one is best for you, but for you to see all the different outcomes, the
Yes.
pros and cons, for you to have awareness of alive and after death, for you to be able to talk about that with your partner, with your spouse on
Yes.
there as well about your own life and your own impacts and your own families. And that's really one of the beautiful things we love doing with people is giving them these visuals.
Yes. And if you found value in this case study, please consider liking the video, subscribing to our channel, and sharing it with someone who may benefit from it.
Yeah, and if you're wondering what your own retirement
Yeah.
may look like, or maybe you already are retired and you want to schedule a complimentary discovery and alignment call here
Hmm.
with Ashley and I both, we have a link in the comments. You can always go to our website here to schedule
Absolutely.
here a call as well. And you can always send us an email. And if you need to have a weekend or a weekday evening, we understand we're
Oh,
working
yes.
parents or kids ourselves. We've done that quite often. So again, those links are in the comments below or at our website too.
Yes. And so we just want to thank you so much for spending this time with us. And we look forward to seeing you in the next video.